Because maybe my OBS having some issue. Pardon me, pardon me. Give chance. Okay. Finally I got it working. Okay. We starting. Let me just do a quick mic test, then we good to go. Sorry for the delay. For some reason, software got issue. Wait. Mic test. Last check and we start. Okay, good to go. Oh yeah, I'm late like 8 minutes, my bad. Final mic check. Last check, starting soon. Really? Okay. Good to go. Hey, welcome everyone. Okay, if my mic not working, please let me know. It should work. I test quite a bit, and it should work. Okay, because I've been trying just now, got some issue. Don't know why every time when I want to launch the stream, I always got some error. Maybe it's the first day of the week. So Monday always machine not working. Okay, Ken. Let me see what's next. Okay, let's start. Hopefully those of you who have end work is okay. Okay, let's start going. So sorry for the delay, some issue with the software, but let's go. So same thing, we have 3 segments today. First thing, we talk about the stocks, okay, the market in general, sentiment, some of the stocks I want to highlight. Second component is the options part. And then the last component is a chit-chat session. Today, I want to talk about this Singapore news, about this vending machine business that people lose a lot of money, lose their pants, lose their underpants. Okay, I think it was like a few $1 million loss of investor were putting some money into this vending machine business. Technically not a scam or MLM, more like the owner or the person who's leading this project. That's why leader very important. This person who lead this project, this vending machine, probably didn't do a good job, I don't know. And the investor probably I just hate to say, probably very high chance can't really recoup back their money. Because investing is always like an optional kind of thing, especially for this kind of private entity, the business. It's optional, no one forces you to invest. So if you choose to put money in, it closes. Too bad. We will cover that at the last part, like a chit-chat session, so it's more relaxed, okay? So yeah, I wish everyone had Mondays aren't that great, but hang on tight, okay? Tuesday, Wednesday, Thursday, then you got a Friday, Saturday, Sunday. So we will journey together on this, okay? Hang on tight. So hope you all have a good dinner and let's start. So today I want to talk about three of my favorite stocks: Apple, Microsoft, and Alphabet. So same thing today, because someone actually asked me this question. So among these 3 companies, Apple, Microsoft, and Alphabet, which one do you think will have the higher chance of doing well, 2x the value in like 5 years time? So I cannot predict the future, so I wouldn't know which one will really 2x in 5 years time, even though I believe most of them can. But I still want to try my best to answer this question to my best ability based on the data and my thought processes, that among these 3 companies, which one has the highest probability, okay? Not financial advice, no guarantee, it's just my own take that I think this particular company would have a high likelihood of doing well as compared to the other 2. So just my own personal take. Okay, so which one will actually do well among all these 3 companies? So to answer this question honestly, I think personally, Microsoft and Alphabet, okay, or you call Google, these two companies has the highest odds of doing well and delivering returns as compared to Apple. Why? Okay, let me just share with you. Because if you look at Apple, they don't really have a strong cloud business or AI business. They do have some iCloud storage, store here, store there, store underwear, store panties, all this, okay, store bra. But it's mainly for consumer perspective. Yes, there's some maybe business, a little bit of business enterprise maybe for their cloud storage or AI system, but pretty much non-existent as compared to if you look at Microsoft, their Azure cloud computing, and Google, they have things like Gemini, okay, Google storage cloud computing service. So you can see Google and Microsoft, they sell cloud, okay, they literally sell cloud businesses to enterprises, okay, to big corporation. So they're selling cloud computing power, storage space, services. They can do things like inventory management, do like systems, do like way to things like how to manage people, manpower, all these things. So they have this cloud service that can do that, be it to figure things out, computing, software coding, all these things. But Apple don't have. Remember, Apple do not have that. So if you look at the Azure cloud or Gemini, all this Google cloud, their businesses, the cloud revenue, example Microsoft, can grow 40% year over year in terms of revenue. Cloud, you know, just Azure cloud alone, that kind of business, intelligent cloud, whatever, 40% year over year. Plus the forward guidance management is so confident that they say moving next few quarter, they can even do 45% or higher. Google Cloud, I think last report, I can't remember exact one, but the last few quarters report, the Google Cloud up by 80% revenue, if I remember correctly. 80%. That is insane, man. Whereas Apple don't have that. Apple mainly focuses on iPhone, user satisfaction, their Apple Store to earn commission services that way. So in terms of cloud and AI, Apple is definitely lacking behind. But I foresee that cloud AI is the way to go moving forward. It's the biggest literally revenue generator in the future. You look at the past report, you can see the growth for cloud is the highest, literally highest component for things like be your Google company or Microsoft. You look at their cloud revenue year over year growth, 40%, 30%, 80%, that kind of stuff. So because of this huge spike, huge jump, plus the future will be probably all cloud and AI, Google and Microsoft will have that edge over Apple. Because Apple just lagging behind in terms of the cloud services. They don't have strong cloud computing businesses. They are not selling those products to enterprises. Literally just consumer transferring file here and there, transfer JAV, whatever, sandwich hub kind of video around. So this is why I think personally, not financial advice, don't quote me on that. I'm just a pigeon, I'm just a bird. So remember, because of this, I think these two companies, Alphabet and Microsoft, will more likely, okay, have a higher probability of 2x in value probably in 5 years' time. So my take is, these three companies, Apple, Microsoft, Alphabet, they all have very good chance in like 5 years' time to double up. Okay, that's my own take. Don't quote me on that, okay, that's my own take. It's a daring, bold statement, but I have a lot of conviction in them. These are my top 3 largest position. But if you want me to try my best to answer this question you all posed to me, I think these two companies, Alphabet, Microsoft, they have better odds of doubling up as compared to Apple. Just want to tell the truth and honest. Okay, just full transparency. That's my own honest view. Because of these two elements, AI and cloud, I really foresee that cloud eventually will be the largest revenue generator. I think so. Okay, there will come a point of time, I think, all computers will pretty much be quite basic. In fact, nowadays you see a lot of computers are quite basic. They don't really have a lot of advanced hardware inside, that kind of crazy or DDR RAM, solid disk, hard drive, SSD, insane graphic card. Nowadays, a lot of computing power services are provided by cloud. Look at NVIDIA. I know I said before, let me just recap a bit. NVIDIA got this graphic cloud processing unit. You can play computer games on a lousy computer, but you can play high-end games despite your computer being weak or very outdated, because they got this cloud graphic processing unit. You can literally key in all the command, play, it transfer to their cloud, NVIDIA cloud, process it and send it back to you. So that's how advanced the future will be. So I foresee in the future, cloud will be the dominating factor. And unfortunately, Apple just don't have that edge currently. And if you look at a lot of tech companies, not just these three, I look at the Magnificent Seven. Not everyone has strong cloud computing power. I know Amazon has, definitely, they're one of the biggest. But you look at, example, Facebook, Meta, they don't have strong cloud business also. They have some capacity, they are looking to sell, but it won't be huge as compared to like Alphabet or Microsoft. So this particular cloud element and AI element gives me the take that they will more likely to double as compared to Apple. So just my honest view. So if you have any comments or disagreement, feel free to share, okay? Before later we move on to the options component. So that's why I can share with you these three are my biggest and largest holding. And I'm confident personally, not financial advisor. These three companies all have huge potential to double up in like 5 years or even 10 years. I honestly don't think it's an overestimate. You look at Microsoft example. Let's look at Microsoft. You look at the price trajectory. Like example, it sank to about 300 plus, then 400, then now climbed to 500. So you just think logically, if they can go from 400 to 500, that's like a 25% gain in that few months. So if you maybe a bit more humble, maybe we think more logically, we don't overestimate. What in 5 years time, can they really double up? I think it is not really very ambitious. Every year they just need to grow like 17% compounded or 18% compounded. They can eventually reach 100% by 5 years time through compounding. So Microsoft now at 500, I think to reach 1K, not a problem in 5 years time. That's my own bold guess. It's a guess. Okay. So don't follow me on that. Okay. If it reach there, good. If it doesn't reach there, well, I just have to deal with it. So plus, we must also remember they have huge backlog. Microsoft has 600 billion backlog. 600 billion backlog. That means they have this huge demand that they have yet to meet and is there waiting for them. It's not like they are begging for business. Businesses are coming to them and say, hey, I want your service. So they have a backlog of 600 billion. Can you imagine in 3 to 5 years time? I won't be surprised the backlog will hit like 800 billion, 900 billion, or even 1 trillion. Not really very fanciful thought, right, if you think logically. Okay, yeah, so that's why I would think that Apple, among all these three companies, has the least chance to double up. But you never know, because the strength of Apple is not really in the cloud service. It lies in the stability. So if you look at all the products, why I think Apple still has a chance is because they have very strong user base, sticky ecosystem, all the mode. I won't repeat that part since we covered in the previous stream. But one thing always must bear in mind, Apple offers stability. You look at iPhone, MacBook, all this, you hardly hear complaints about lousy software or issue with hardware or the blue screen of death, or Samsung, some suck, right? They call it some suck phone. All the green line after you use 1 or 2 years, got all the green line error, all the bullshit, then you must throw away or spend a lot of money to repair. Apple, no such thing. I have yet to hear Apple got green line, blue line, red line one, or rainbow line. No. That's why their product is not very advanced if you go and look at their specs compared to like Samsung or this. Apple, though, is a simple phone, with all the very... If you look at the specs and hardware, people usually feel that the hardware don't justify the price. But people still buy. Why? Because their combination of hardware, software, and excellent customer service provide a very stable product. Even if the iPhone got some issue, they just go back to Apple Store, The Apple iCare is very good, very best service in the world. You ask them, give it to them, they will fix it in a few hours or even 1 hour. If they can't fix it, one-to-one exchange. Usually that's the case. I've used Apple before, so I know how it works. So that's why despite Apple lagging behind in terms of cloud and AI, they are strong customer service, stable products. All this leads to convenience. You don't want to buy a product that's unstable, like Samsung, or even sometimes Xiaomi got a lot of issue. I've used all of this phone before, I know. So imagine you use halfway, then got a error, this issue, that issue, it cannot log in, that kind of stuff. Then it becomes very frustrating. You rather spend more to buy a stable product, and that gives you convenience. Every time spoil, I need to go repair, then repair give me so many comments, so many trouble, say cannot do this, cannot do that, must top up money. All these are nonsense. But Apple, no such thing. They really package everything well, give you the convenience, give you the stability. So that's why Apple will likely continue to sell their products, no problem. Because they have established such a strong branding, strong ecosystem, strong product, people willingly buy. So personally, I think Apple also has a very good chance to do very well in like 5 years' time. So that's all for my comment on these three company. I don't want to speak further, okay? So if you have any comments, please let me know about this, whether you agree or not about this Apple, Microsoft, Alphabet, and why I think Alphabet and Microsoft has that edge over Apple because of cloud and AI. But good news is Apple did mention they are actually trying to catch up on the cloud service and AI by incorporating Alphabet Gemini, okay, into their system, and they're trying to build this cloud enterprise, so-called expand the capacity, like do more, provide more services. But we yet to know, yet to see it. But I can upfront tell you one potential gap here. If you realize most corporates out there, okay, most businesses in the world, they use what? Microsoft, Windows OS, all this. Most people, most company enterprise don't really use Apple that much as compared to Microsoft. So that's one truth first. So I don't know if, let's say, they provide some form of cloud enterprise services, will there be compatibility issue? Will those companies be concerned that, hey, I'm using Microsoft Windows OS, then I purchase cloud services from Apple, will there be compatibility issue? So that's one barrier. There's potentially an issue for Apple if they want to expand to cloud businesses, all this. So that's the end for my first part, okay? And I won't speak further. Any comments, questions, please feel free to let me know, okay? I see, I miss it. Hey, Yaf, good to see you. Hey, good to see you again, Yaf, good to see you. Hey, sorry for the delay earlier, by the way, because I think the software was having some issue I was trying to figure out. Hope you had a good day, Yaf. Hope you had a good day. Hey, by the way, anytime my mic not working, feel free to let me know, okay? Because previous stream, there was sometimes my mic not working. Then I realized I was talking to myself for like 20 minutes. Yeah, but I should change it, not starting soon already. Okay, put my face on top. Okay, so today I want to speak further on the Apple, Microsoft, Alphabet. And those are my thoughts so far for these three companies. And if I have to choose, yeah, I think Alphabet and Microsoft really has an edge over Apple, to be honest. Just being truthful. Okay, so second component, let's go to options now, okay, so we don't delay further. So by the way, questions, comments, feel free to highlight so I can learn from you as well. Okay, so options is, can see, let me see. Okay, wait, give me a while, I change my position of the option. Wait, give me a while, sorry. Okay, I think this works. Yeah, so first screen on top is all my options holding, okay, and the second is the market. So market will open in 3 minutes time. Hey, market open today, let me see. Because sometimes I got holidays, you know, so sometimes I miss it. Yeah, market will open, market open. Okay, okay. Sorry. Okay, back. Okay, so today, right now, we want to talk about the options component. So today, I want to share with you on cash flow. It's a bit heavy topic, but let me try to summarize it and share with you my personal experience. So in case you all don't know, I'm an option wheel trader full-time now. Some people call me option grinder, okay? So I mainly sell options contract, be it cash cover put or covered cost. So I won't dwell on the fundamentals because we covered it quite a few times in the previous stream. If you're new here, you're not sure some of the concept, feel free to watch my longer video. I have 2 longer video on YouTube that talks about the fundamentals of options. So you all can go there, take a look if you want to know. But if you have questions, can ask me or even ask ChatGPT. They can define for you and explain probably better than me. So we will talk about some of this cash flow concept first, how I use and how I maximize it before we move on to the market. Once market open, we go in and identify potential opportunities, trades, and I'll share with you all live what are my thoughts and what kind of trades or position I plan to open for today and this whole week. Okay, so for option wheel strategy, just to share, okay, option wheel strategy, which is mainly focused on selling options, is about selling cash cover put. You get assignment, then you convert to covered cost. Then covered cost get caught away, your shares get caught away, you repeat back the cycle, selling cash cover put. So primarily, when you want to do this wheel strategy effectively to really extract all the value, you cannot just look at these 2 concepts. You have to think about the cash flow concept. So I give you an example. Example, you look at my first picture on top, okay? It's all the options position I'm holding. So I give you one scenario. Example, okay, I have just random scenario. Example, I have 1 million worth of contract options put. Let's talk about options put, okay? For the next 2 years. Okay, example, 1 million worth of contract for the next 2 years. So I have 1 million cash now with me in order to stand by for assignment over the 2 years period. Now you think logically, do you need the 1 million right now actually? If you have contracts that are expiring in year 2 or even year 3, right now is year 1 first month, do I really need to hold 1 million cash with me to prepare for year 2, year 3 assignment? Technically not really. So if you think logically, if I hold cash 1 million right now, I'm not utilizing the cash well. I'm not really maximizing it. Yes, I'm doing the wheel strategy in a way, but you are not really maximizing all the cash you have on your hand and the wheel properly. So you are not really extracting full value. Imagine, let's say year 1 you only need like 500k, then year 2, year 3 you need 250k followed by 250k. By right, I can use $500,000 to do other investment. Okay, buy something else, buy ETF or whatever, okay? Because I just need to stand by 500k for this year 1, to manage all the assignment. Then by the time year 2, year 3 come, I make sure there's cash flow coming in for year 2, year 3. Be it covered call, get caught away, or I got dividend income or salary. Whatever cash flow you have, just make sure by the time money arrives for year 2, year 3, is enough for the contract during that period of time. So this is the whole concept of this cash flow management. You want to maximize the amount of money you have right now and extract the full value from the options without over leveraging or not creating enough buffer. So this is why I want to talk about this part, to really extract full value from the options, okay? Just selling cash cover put, covered call, hold all the cash, not really fully extracting the value. So disclaimer, I want to make this part very clear. This one is really not suitable for beginners or newcomers, okay? If you are more experienced, well-versed, this will really truly, is the essence, I feel it's the essence of the wheel strategy that really makes you way more money than just a simple wheel strategy. But if you are new, you don't know how to manage your cash flow, please avoid this strategy, okay? For a start, just be humble, make sure you have the cash ready at all times. Okay, if you really have 1 million worth of contract over the next 3 years, okay, you may get assigned, then please prepare 1 million cash right now and stand by for 3 years. so be it, just hold that 1 million cash. But if you are more advanced, then you can start adopting this strategy. Okay, so I just want to share that, let me go through. Yeah, so I just want to talk about having cash flow, make sure you are ready for the months. So people ask me, so how long in advance should I prepare the cash? Example, let's say I have contract expiring this month. Should I make sure I have the cash flow 1 month before, 2 months before, or 3 months before? So this part is completely up to you. It's personal preference based on your risk tolerance and your management skill, okay? So personally, I share with you, I will always make sure I start preparing for this month 1 to 3 months in advance, okay? So let's say this month I have 100K worth of options that may get assigned to me. Then I make sure 1 to 3 months beforehand, I make sure I have 100K ready for this month. Okay, so that's my own personal preference. 1 to 3 months, start getting ready for the coming month. I mean, 1 to 3 months before, get ready for this month. So make sure you have the money to manage assignment if you are assigned. So remember, option strategy, if you want to do this cash flow management, this assignment, whatever, okay, you must always have the concept that you could get assigned. Okay, always tell yourself you could get assigned. Don't think that, oh, this contract maybe I won't get assigned. That contract I may get assigned. This is very dangerous, okay? This is how you bust your account or destroy your whole financial system. Always have the mindset that I could get assigned and I need to prepare for it. So this is why I said before in my previous video, rolling options is a very important skill set and strategy you must learn. So when it comes to this cash flow, like I talked about earlier, right, you prepare 1 to 3 months in advance, then this month I get assigned. So things can go south. You never know what something happens, and then suddenly your cash not enough. How? That's where rolling comes into play. Okay, so rolling just means you close the contract at a loss, okay, you close it, and then you sell another option contract further up, be it like 1 month, few months later or 1 year later with a further strike price to recoup back the loss. Remember, every time you sell a contract, you get premiums. So yes, example, I pay $100 to close this contract. Because I don't want the assignment, okay, I close this contract. Then I will probably have to sell another one, maybe further up, to get like maybe $100 premiums or $120 premiums to cover this loss. That's called rolling. Close the current contract at a loss, sell another one further out for a credit, or so called to recoup back this loss for more premiums. So when you don't want assignment, that's where rolling comes into play. Close the contract, then you won't get assigned. So remember, taking assignment is usually higher in terms of capital. It's more capital intensive as compared to closing contract. I give you an example. Apple, let's use Apple. You have an Apple cash cover put, $100 strike price. Ding dong, assignment comes, okay, Apple dropped to $80. Your contract expire, assignment comes in. Because you strike price $100, you must buy it at $100, even though Apple is worth $80 now. So if you take assignment, it will be 100 times 100 shares. That's $10,000. You need to cough out 10K cash for this. But if you close the contract, maybe you just need to pay like 2K, 2.5K, or 3K, depending, okay? So you can see the huge difference in terms of capital required. So when you do this cash flow concept in this view strategy, you must learn rolling. Okay, you never know. You never know. One day, the cash flow you anticipated is not enough. Trouble is trouble. Okay, remember, if not enough cash and you never set instruction like to roll or whatever, they will forcefully close some of your position. Anyhow close, they don't care about you. Your broker will just anyhow sell whatever to get enough money to cover this. Whether you have to take assignment or whether to forcefully close your contract. Each broker has their own rules. So you want to avoid that. So must learn rolling, okay? Rolling is the most important strategy in this selling options, selling cash cover put, or even covered costs. Okay, so that part is about rolling, and so I talk about assignment, risk, and about rolling to avoid getting assigned, to help you with your cash flow anticipation and preparing like 1 to 3 months in advance. So you see, if you are more seasoned, you definitely can have less time to prepare, maybe just 2 weeks, you can make sure there's enough cash flow. That's up to you. Okay? So you really don't really need the amount of money. Let's say your contract is expiring in 3 years later. You don't really have to prepare the money now, right? Technically, okay. But remember, like I said before, one of our viewer has highlighted, you could get assigned early. So also be prepared. Be prepared. Okay. So when it happens, you just have to manage it. Okay. So another thing is to better manage your cash flow when it comes to assignment. When you sell cash cover put, always try to have a buffer. So if you plan like, I need 100K this month. Example, you have 100K of option cash cover put that could be assigned to you, okay? Don't just prepare 100K exactly. Try to prepare at least 110K, 120K. My personal preference share with you is 20% buffer. So I'll always prepare, let's say 100K I need this month. 1 to 3 months before, I'll prepare 120K. I'll make sure that this month I will have 120K at all times in case I get assignment. Okay. Yeah, drink some water first, sorry. Okay, so with the wheel strategy, you need to know where are your sources of income. So remember, wheel strategy is very different from traditional buy and hold. Buy and hold, where's your source of income? Probably your salary only, right? No other source of income, salary. Unless you buy some dividend stocks, maybe you get some dividends. But you buy most companies out there, even the tech stocks, they give you very little dividend, almost non-existent. So wheel strategy itself has multiple sources of income that you must think through to maximize it. So number one is really premiums. Okay, with the most juicy part. When you sell cash cover put, you get premiums. So cash, you get money for that. Similarly, when you sell covered calls, okay, you own 100 shares of Apple, example, you sell a covered call option on it, you also get premiums, money. So this is one source of income to help you for your wheel strategy. Now number two is dividends. So even if you sell options on all these stocks, like I think Apple and Microsoft also pay dividend, but very small amount, okay? Let's just use that example. Even though you sell contracts on the shares you own, you still get dividends because you still hold the shares. Contract is another separate matter. It's the option contract, nothing to do with the shares you hold. So dividend itself is also another source of income. That's why our options are really quite powerful, to be honest. The moment I discover it and I really learn in depth about options, wow, it's like open up a whole new world to me. Like, like suddenly I'm living in Mars or Pluto, Suddenly I see so many new things, new perspective. Then the third thing is, also remember, when your covered call get exercised. So example, you sell 100 shares of Apple. 100 shares of Apple, strike price is $100. But your cost price of Apple is only $80. Example. So Apple from 80, 100 go up to 150. Yes, your Apple shares will get caught away. Because your strike price is 100. So you have to agree to sell 100 because it's a covered call, it's a contract agreement. Even though it's $150, you have to sell them away $100. But you still make money. $80 to $100 is still $20 profit per Apple share. 100 share is $2,000. So remember, when your shares get caught away, you also receive income. It's not just capital gain, it's the entire shares that is sold in value. So example, 100 shares of Apple at $100 each, it gets caught away, you receive $10,000. Okay, remember, you receive 10K from capital appreciation plus the share price you sold it away. So this 10K, when it comes in, when your covered call expire, it gets caught away, it's also another cash flow. Okay, so to summarize, option wheel strategy has three main cash flow, okay? Premiums, dividends, and when your covered call get caught away, when you get expire or get assigned to someone else. So all this actually could give you good enough cash flow if you know how to do it. So it will come with experience to know when dividends get paid, when your covered call potentially high chance to get caught away, and the premiums do add up. Don't underestimate the premiums. If you have a lot of contracts stagger, the premiums do add up. And remember one very important thing. the moment you sell an option contract, you straight away get the premium. Okay, very important. You don't wait till option expire, then you get the premium. Not that way. You sell, you get the premium straight away. So that itself is also cash flow for you. So imagine I sell like 20 contracts over 2 years of period time. Example, 1 month later, 3 months later, 6 months later, 7 months later, 8 months later. I keep selling contract right now. Okay, right now I sell already. Today I sell 20 contracts over 2 years. Straight away I get the premiums for the 20 contracts. Not end of 2 years then I collect. No, it's straight away. So the straight away is a huge cash buffer to you. So that's one thing you have to bear in mind, okay, to really maximize this option view strategy. Of course, having said that, it's also personal financial status and liability. If you have a lot of commitment, then maybe your cash flow will be lesser. If you have a job, even better. You know that every month you will collect your fixed paycheck like 4,000, 5,000 or whatever. So that also adds to your cash flow. But if you talk about option itself solely, that is the 3 main cash flow component you should take into consideration when you want to keep cycling the options wheel strategy. And I hope the explanation is a bit clear. I hope not too confusing, okay? So I will just add on a little bit more, then we move on to the next part, okay? I hope it's not too heavy. I hope I managed to explain in simpler terms, okay? Okay, so one last thing, not say one last thing, one key point to add is also, don't assume your covered call will get caught away also. Imagine you sell a covered call, sometimes the covered call don't get caught away, okay, but you still get to collect the premiums free. So if your covered call don't get caught away, you don't really have the cash flow for that selling of shares. So bear in mind that. Cannot always assume you set a covered call, it will certainly be exercised and caught away, and I will get the money from the shares sold away. It may not happen. So also bear in mind that. But the upside is if it doesn't get caught away, you get to keep the premiums. And then you can sell another covered call on those shares. So just keep repeating it. Okay, so I just want to share with you quickly my personal experience and my own take on it. Just a small mini guide based on my personal experience. Okay, not financial advice. You have your own system, own rules. You can consider all the things I said earlier as a fundamentals or points for you all to think through which one works for you, which one doesn't. But I just want to share with you my personal experience, what I encountered, especially during the first few months when I went heavily into this option view strategy, where I really, go all in to extract all the value, understand this, trial and error. So through personal experience, I want to give you a few tips is that look out for high IV stocks, high implied volatility. So example, Nvidia, the implied volatility is 40%, whereby others is like 20%. So higher volatility, higher IV, okay, means that prices will swing faster and higher. So just keep in mind that stocks that are higher IV, you want to pay more attention. They have higher risk of being assigned to you, and also higher risk of getting caught away. So hopefully this helps you with your management in terms of identifying which cash cover put more likely to get higher probability to get assigned to me, or which one more likely to expire worthless, I keep the premium. Same goes for cover call, which one more likely to get caught away. So high IV is something that you can use in your decision metrics to decide whether this one good chance to get caught away. Then another thing is, okay, once again, it's just a personal thing, not a full guide. A good idea is to keep the ratio 1:1. So example, if I have one cash cover put expiring this month, I also try to make sure I have a one covered call expiring this month. So if the covered call gets caught away, the money will come in, and this money could help me to manage the cash cover put if I get assigned. Okay, clear this part. So 1:1 ratio. One cash cover put in this month, I will make sure I have one covered call in this month that's also going to expire, so they can try to equalize, manage each other. Gets caught away, I get the money for the cash cover put. So just a rough guide for you. When I started these options, selling more intensively, this was something that I realized it helps me with managing the cash flow. Whether you want to use Excel sheet, calendar, Microsoft Cal to track for you. It's all personal preference. But personally, 1:1 ratio tend to work for me. If I have 5 cash cover put, then I will try to make sure I have 5 covered call that will likely expire during that period of time. Okay, so just last, not say advice, not good enough to give advice. Last sharing is that try to always make sure you have enough cash to at least close your contract. I repeat, close your cash cover. You know, just now I talked about rolling. You roll is you close the contract at a loss, then sell a further one. So closing contract is always less capital intensive as compared to taking assignment. Remember, when cash cover put you get expired or you get assigned the stocks, doesn't mean you must take it. You can always close the contract earlier, and that helps a lot. Yeah, if the person exercise and sell you the shares, you have no choice but to take it. Remember, the other party can exercise anytime. You have to take it. But usually they won't exercise too early because, like I said, the value of the time of the contract, the duration has value. Okay, you call it extrinsic factor or you want to call it time value of the contract, same thing. So 1 year worth of 1 year contract, the time value is higher as compared to 1 month contract that's going to expire. The time value is lesser. So most people out there, generally they want to hold the contract longer because the time value is there. They don't want to give it to you for free. But unless the stock price crash a lot, they make so much money, then they may just exercise and you have to take assignment. So this scenario can happen. Okay, so back to this part is always try to have enough cash at least on hand to close the contract when things not in your favor. Be it you want to roll later or just close at a loss, then call it a day, up to you. Usually I will close it and then sell another contract, which is rolling. So at least if you have enough cash on your hand to close this contract when needed, there's always a safety net for you. So if things go south, one day market crash 30%, 40%. If you have to take all the assignment, you look at my first picture as example. If one day, let's say all these contract expire today, okay, the contract on top, if it market crash by 50% example, I take all the assignment on top, easily what, $600,000 or even higher. That's the amount of contracts I have on top. But imagine if I don't take assignment, I just close them. I probably don't have to call for 600K. Maybe it will be like what, 100K or 80K depending on the situation. So just remember this concept. Closing contract is always less capital intensive as taking assignment. So this part hopefully is a good tip for you as well. So try to just make sure you have enough cash on hand. Cash, not cash flow now. I'm not talking about money coming in. Cash on your hand to close contract. That's the worst case scenario. Okay, so this whole idea is that I create this system is in a way that it can withstand most scenario, be it market crash, bull, bear market, I still can survive, I still can make money. The wheel system continues to wheel and wheel and wheel. So that's the whole idea of this option wheel strategy. You want to keep the wheel spinning, not stop halfway. Just because market crash, I'm stuck with the stock, I cannot sell any more options or whatever. I don't think that is a very good way to use the wheel. You don't want the wheel to pause, you want it to keep spinning. So you have to really consider cash flow to really extract all the full value, maximize this strategy to collect as much money as possible. Okay, so I don't really have a fixed formula for y'all. It really depends on your personal finance, your liabilities, how much income you have. So I hope this sharing helps y'all about this cash flow management. If you're more into advanced option view strategy and you want to do this, something for you to think about, especially if you want to do this full time. Okay, so some people want to use the option view strategy full time. I know there are some other people who are doing this for sure. These are the things to consider. Okay, any questions, feel free to let me know. I know I talk a lot on this part because this part a bit heavy, but I hope that this cash flow concept management gives you more insight rather than just tell you all the same old thing again. Options is about selling cash cover put, assign and sell cover call. I think you're all bored of it. So hopefully this personal sharing gives you more in-depth and different perspective on this option view strategy and cash flow management. Cash flow is very important, okay? Very important to do the option view strategy well. Okay, so that's it. Let's go to the market. Let's identify any opportunity. Any questions or thoughts, disagreement with me, or even if you are trading options, doing your own method to manage cash flow, feel free to share with me so I can learn from you as well. Okay, so let's just move to the market component, okay? The second picture is the market now. So let's see any opportunities today to sell any options contract and make some cash, okay? Let's all make money. Let's all make money. Okay, Microsoft is down a bit, 485. Feels tempting to sell a cash cover put on Microsoft. Let me think about it. Alphabet is also down a bit. SPY down a bit. Okay, that's the red part. Let us look at the green part. Okay, SpaceX is up 10 cents. Okay, wow, good. I hope Tencent and Alibaba can trend up faster because I really hope to exit some of my China stocks. Okay, Nvidia, okay. So I personally don't think market has any huge swings today. Seems like quite stable. I don't see any like huge upswing, upticks, all these things. So I let you all know personally at this juncture, Microsoft looks very tempting to me. Let's just examine the premiums, okay, today. Let's just examine the premiums. So I also can show you all some of the premiums. Okay, so let's just look at today. Let's just look at 46 days. Okay, the contract. Can see, okay, can see. Okay, so you see the highlighted that I put about 0.194 or 0.2 delta. So this contract strike price is 450, and you could get a credit. Bid and ask is $5 to $5.90, so you can get $500 to $590 if you sell this for the 6-day contract. So you can see a lot of green here. That's why I say when the stock itself goes down in value, like Microsoft just now dropped by 1.something%, the underlying options for cash cover put will spike up. That's how it works. So usually when the price drop, the stock price drop, it's a good day to sell cash cover put because your premiums will be higher. And just now I talked about IV, right? Implied volatility. Look at this middle column. I point my cursor. So remember, IV is how fast, how volatile it is. So Nvidia is like 44%. I think SpaceX is 60% or even 80%, I don't know. So remember, the higher the IV, the higher premiums for sure, but also the higher risk of assignment or getting caught away. So bear in mind that when I'm doing the option view strategy, so IV is something for you to consider, not just in terms of the higher premium, but also think about how you're going to manage when you get assigned or when the stocks get caught away. So something to consider. Okay, so to be honest, I think Microsoft looks quite tempting to me at this juncture to sell a cash cover put. So I'll be upfront, usually I don't trade in the first hour of the market because it's usually too volatile. I will start trading in the second or third hours onwards. My philosophy, early bird catches the worm, but early worm gets eaten by the bird. So I don't want to be the worm because I'm a bird. So I tell you upfront first, if Microsoft continues to dip a bit more, likely tonight I will do a cash cover put on it. Because I don't have any more cash cover put on Microsoft, I close all of them at a profit. So I just share with you all first upfront, okay, transparent, that there's a good chance I will sell a cash cover put today on Microsoft. So tomorrow, same thing, I will update your live that whether I did sell a cash cover put on Microsoft. Live, okay? Live, no problem. I will update your transparent. Then you all can see the difference. You see my first screen? Got all the contracts. Then you all can see, hey, there's a new contract, Microsoft. So if I do it, I update you all tomorrow. Because first hour I don't trade. I will only trade like later. Okay, so that's the only opportunity I can identify today for cash cover put. Even though I really want to sell an Alphabet here, but I did hold quite a lot of alphabet put position. I don't want to overload myself with too many positions. So that's about risk management. I don't want to be greedy. So I'll aim for Microsoft tonight. Let's hope we make some money, okay? So those who also going to bought Microsoft, I mean, if you're also selling options, feel free to share me your thought process also. Then we can discuss. End of the day, I hope everyone makes money, okay? Everyone come together. If you are into option selling, even better. We discuss strategy, and then we can sell contracts together and all make money. Okay, so let's just look at the other side. So we see any potential for me to close my existing contract. Okay, so the NVIDIA put, one of them has hit 42% profit margin. I think high chance I will also close tonight, but let me monitor a bit. I shared before, but just let me quickly recap. Usually I aim for 50% profit margin because example this NVIDIA put, it still has like, okay, the one I highlighted, NVIDIA, you see the first screen. It expire in next year September. So that's like what, 11 months. 11 months for the remaining 58% profit. I'm already holding 42% of the premium profit for this particular contract. I don't think it's worth it to hold 11 months more for the remaining 58%. Why do I want to wait 11 months just to get the 58%? And during this 11 months, anything can happen. NVIDIA result is coming soon, in like 2 weeks time. If they announce bad results or the next few quarters got bad earnings, this contract can be from profitable to loss making. So I don't want to take the risk. So option strategy, selling options, especially the wheel strategy, also is about risk management. Don't be greedy. If you think that the macro or micro factors that's upcoming is not worth the risk, then even if it's 40%, 42%, 45% profit margin, it's good enough to close. Don't always have to aim for 50% or 100% profit. That is just the way, honestly, greed, that is called greed, to be honest. That is a sure way to eventually bust your account. So just take profit when it hits your target. Whatever preference you have is up to you. Just sharing with you my personal preference is that I aim for 50%. If there are some concerning factors like upcoming earnings result, all these things, even at 42%, I will still close it. Okay, so for this particular contract, right, because one of you, in fact, Yap, right, asked for a recording of the contract closing procedure. I found a way to record this process. So tonight, I think actually some of you actually requested, I think especially Yap, that you want me to demonstrate how I actually close the contract and how I sell the contract, like which button to press, right click, left click, the whole entire process. So I will try to record a video tonight when I close it. Then you all can see how it's done, the whole entire process. Okay, what I said earlier is my thought process on why I choose to close. But I try to show you the how part, like what button to click, all these things. Because I figure out a way to record this video, okay? So I'll show it to you. In fact, I want to quickly share with your life actually I figured out. But I can't proceed further because of some sensitive info when I click some buttons. So I share with you roughly how to close the contract now, okay? Let me just share with you. Sorry, pardon me if my software... Hey, Yaf, I hope you are here, by the way. Or anyone who wants to see the process, okay? How do I actually close it? Let me see. Wait, what like that? Okay, sorry. Okay, I know the screen a bit confusing, so let me just quickly demonstrate to you how it works. I hope it works.